Every professional knows this truth. The market doesn't care about your analysis, your indicators, or your conviction. It only respects one thing: your discipline to cut losses swiftly. While amateur traders hold losing positions, hoping and praying, the professional executes the stop without hesitation. This single action, practiced religiously, separates those who survive from those who don't. The difference isn't knowledge, it's execution. For example, watch any struggling trader, and you'll see the same patterns. A position moves against them by 2%, then 5%, then 10%. They convince themselves it's temporary. Meanwhile, the professional, they're out at their predetermined stop, capital preserved, emotions intact, ready for the next high-probability setup. One protects capital first, the other protects their ego. The market rewards only one of these approaches. Gentlemen, let me speak plainly about a principle I learned through bitter experience and considerable financial pain in my early years on Wall Street. The speculator who enters this game thinking first of profits is already halfway to ruin. I don't care how brilliant your analysis, how perfect your chart reading, or how convinced you are of the next big move. If you haven't mastered the art of capital preservation, the market will teach you this lesson at tremendous cost. When I began my career as a stock runner, I observed something peculiar about the successful operators who moved millions while others consistently failed. These men, the true professionals, the composite operators who controlled the market's pulse, thought differently about money than the public did. The average speculator walks onto the floor asking, "What's going up today? Where can I double my money?" The professional asks an entirely different question. Where am I absolutely wrong? What's the maximum I can afford to lose on this position? This isn't pessimism. This is mathematics and survival. Your capital, my friend, is your business inventory. A dry goods merchant understands that without inventory, he has no business. He protects that inventory from fire, theft, and spoilage with vigilance. Yet the speculator, dealing in the most volatile inventory imaginable, often treats his capital with reckless abandon, as if the market owes him replenishment. It owes you nothing. I've seen brilliant men who could read a tape like I read the morning newspaper, completely wiped out because they violated this first law. They had everything except discipline over their capital. They let single positions grow into oversized bets. They held losing trades, watching their capital evaporate by 20%, 30%, even 50%, always believing the market would validate their opinion eventually. The market doesn't care about your opinion. Here's a truth I discovered through careful study of the successful operators. They viewed each trade not as a chance to prove themselves right, but as a business transaction with defined risk parameters. Before committing capital, they calculated precisely what they were willing to lose, not what they hoped to make, what they were prepared to sacrifice if wrong. This represents a complete inversion of how the public thinks. The public sees a stock at 50 and dreams of it reaching 75. They calculate potential profits, spend those imaginary gains in their mind, and size their position accordingly. The professional sees the same stock at 50 and immediately determines, if this breaks below 48, my thesis is wrong. I will risk $2 per share, position size accordingly, and exit without question at that level. One approach is built on fantasy, the other on cold, hard mathematical reality. I cannot overemphasize this principle. Your first, second, and third obligation as a speculator is to preserve your capital. Profit is what happens when you consistently protect your downside while participating in legitimate opportunities. The speculator who loses 50% of his capital must make 100% on what remains just to return to even. These mathematical realities are unforgiving. Guard your capital as you would guard your life, because in this business they are one and the same. I want to address what I consider the most critical technical skill in speculation, one that separates the professional from the amateur more decisively than any other single factor. It's not the ability to read charts, though that's important. It's not understanding market phases, though I've built my entire method around that concept. It's the ability to determine your exit point before you enter the position, and then honor that decision with absolute, unwavering discipline. Let me be direct. If you don't know where you're wrong before you buy, you have no business making the trade. I learned this principle watching the tape in the old days, observing how the big operators, the men who consistently accumulated wealth while others churned their accounts, approached their positions. These men never, and I mean never, entered a trade on impulse or hope. Every position was planned like a military campaign. They knew their entry point, their price objective, and critically, their exact exit if the market moved against them. The amateur does this backwards. He buys first, then begins thinking about where he might sell. As the position moves against him, he starts negotiating with himself. Well, I thought my stop was 48, but the volume pattern suggests accumulation, so perhaps I'll wait. Or worse, I've already lost this much, what's a few more points? This is not trading. This is financial suicide on the installment plan. Here's what I demand of myself and what I recommend to every student of speculation. Write down your stop, loss point before you commit $1. Not a mental stop, a written, recorded, irrevocable price point. Better yet, place the actual stop order with your broker immediately upon entry. Remove the decision from your future self, because your future self, the one watching red numbers grow larger, cannot be trusted. Why? Because once you have a position, you're no longer objective. Your ego becomes involved. Money is at stake. Fear and hope begin their insidious work on your judgment. The mind that analyzed clearly before entry becomes clouded by emotional attachment to being right. I've watched this transformation destroy more speculators than any market crash ever did. The professional determines his stop during the analysis phase when he's calm, rational, and detached. He studies the chart structure, identifies the critical price level that would invalidate his thesis, and sets his stop just beyond that point. This happens in the planning stage, not in the panic stage. And here's the crucial element: once set, that stop becomes a sacred contract. Not a suggestion, not a guideline, not something to reconsider if you get new information after the position moves against you. The market will constantly test your discipline, probing for weakness like a predator sensing injured prey. I've seen the composite operator run stops deliberately, shaking out weak hands before making the very move those speculators anticipated. It's maddening to watch, unless you understand that your stop represents the price you pay for being wrong, and that price was acceptable when you planned the trade. Honor your stops like you'd honor a debt to J.P. Morgan himself. Your financial survival depends on it. In my 30 years observing the market's machinery and the men who operate within it, I've identified one quality that separates the consistently profitable trader from the perpetually struggling one. It isn't intelligence. I've known brilliant men who couldn't turn a profit to save their lives. It isn't capital. I've watched wealthy men lose fortunes while modest speculators built substantial accounts. The differentiating factor is something far more subtle and infinitely more difficult to master: the ability to execute without emotion. Anyone can learn chart reading. Anyone can understand the principles of accumulation, markup, distribution, and markdown. I've taught these concepts to thousands of students, and most grasp them intellectually within weeks. But teaching someone to act on that knowledge when their money is on the line, that's an entirely different proposition. Let me describe what happens to the untrained speculator when a position moves against him. He buys at 50, convinced through solid analysis that the stock is entering markup. It drops to 49. His mind immediately begins manufacturing explanations. Just a minor reaction. The big operators are shaking out weak holders before the real move begins. At 48, he's no longer analyzing, he's defending. His ego has become involved. Admitting the position is wrong now means admitting he is wrong, and the human mind will perform remarkable gymnastics to avoid that admission. By 47, he's already abandoned his stop. By 45, he's considering averaging down. By 40, he's paralyzed, unable to sell, because the loss has become too painful to actualize. He's transformed from a speculator into a victim, from an active decision maker into a passive sufferer of market whims. Now observe the professional in the identical situation. He buys at 50 with a predetermined stop at 48.50. The stock drops to 49, then 48.75. At 48.50, he sells. No hesitation, no negotiation, no emotional turmoil. Why? Because he made the decision to exit before fear entered the equation. The sale isn't personal, it's procedural. His thesis was invalidated at that price point, therefore the position is closed. The emotional experience is equivalent to a shopkeeper marking down spoiled inventory. Unpleasant, certainly, but necessary, anticipated, and completely manageable. This is what I call emotional discipline, and it cannot be overstated. The professional experiences losses as business expenses while the amateur experiences them as personal failures. I learned this distinction painfully in my early years. I remember positions that I intellectually knew, were wrong, yet I held them because selling meant admitting defeat. That internal conflict, that war between knowledge and ego, cost me dearly. It wasn't until I developed the ability to separate my self-worth from my market positions that I began trading successfully. Here's my advice, forged through hard experience: treat each trade as a scientist treats an experiment. You form a hypothesis, you test it with capital, and the market provides data. If the data contradicts your hypothesis, you don't argue with the laboratory results. You accept them and move forward. The market rewards emotional detachment. Master this, and you've conquered the greatest obstacle to speculation success. Let me share with you a mathematical truth that transformed my entire approach to speculation, a truth so simple yet so profound that most traders never grasp it until they've been thoroughly educated by the market at devastating cost. The secret to lasting success in this business isn't found in picking winning stocks or timing perfect entries. It's found in the arithmetic of survival. Early in my career, I kept meticulous records of every transaction, every gain, every loss. I recommend this practice to all serious students of the market. Through this record keeping, I discovered something that contradicted everything the public believes about successful speculation. The consistently profitable operators I studied weren't right more often than they were wrong. Some were correct barely half the time. Yet they prospered year after year, while others, who picked winners at a higher rate, eventually went broke. The difference was in how they lost. Consider the mathematics carefully, because your financial life depends on understanding this principle. A speculator who disciplines himself to accept losses of 1% to 2% per position can sustain 20 consecutive losing trades and still retain 80% of his capital. 20 losses in a row! The psychological blow would be severe, certainly, but the financial damage remains manageable. He's still in the game. He can still participate in the next genuine opportunity. Now examine the undisciplined speculator who allows losses to run to 10% before finally capitulating. 5 consecutive errors, just 5, and he's devastated 40% of his capital. To recover to break-even, he must now generate returns of 67% on what remains. The mathematics become progressively more punishing. A 50% loss requires a 100% gain to recover. Lose 75% and you need a 300% return just to get back to where you started. These aren't theoretical numbers. I've witnessed these exact scenarios destroy speculators who possessed genuine market insight, but lacked discipline over their losses. The professional understands something the amateur never grasps: small, controlled losses aren't failures. They're the cost of doing business in an uncertain enterprise. When I operated my brokerage, I calculated these costs just as carefully as I calculated rent, salaries, and telegraph expenses. They were anticipated, budgeted, and accepted as the price of market participation. Large losses, however, aren't educational expenses. They're catastrophes that eliminate future opportunity. I cannot state this forcefully enough. The market will always present another setup tomorrow, next week, next month. The patterns I've taught you, accumulation, markup, distribution, markdown, repeat endlessly. Opportunity is infinite for those with capital to deploy. But here's the terrible truth. Opportunity is worthless to the speculator who's been knocked out of the game. I've known brilliant tape readers, men who could anticipate market movements with uncanny accuracy, reduced to spectators because they allowed one or two positions to destroy their capital base. They saw the opportunities afterward. They simply lacked the means to act on them. Your goal isn't to avoid losses. That's impossible in this business. Your goal is to keep individual losses so small, so manageable, that you can absorb an inevitable string of them and remain a viable operator. Survival isn't the most exciting strategy, but I assure you, it's the most profitable one over time. I'm about to share with you a concept that will sound contradictory to everything you've been taught about success in speculation. It certainly contradicted my own thinking when I first encountered it through observing the great operators of Wall Street. Yet once I understood and internalized this principle, my entire career transformed. Here it is. A perfectly executed losing trade is more valuable than a profitable trade executed poorly. Let me repeat that, because I know your mind is resisting it. A loss taken according to plan, with proper position sizing and disciplined exit at your predetermined stop, represents success. A profit made by violating your rules, holding past your stop, or oversizing your position represents failure, regardless of the monetary outcome. This seems insane to the uninitiated. The public judges trading by one metric only: did I make money or lose money? By this standard, the speculator who removes his stop, averages down recklessly, and eventually exits at break-even after weeks of anxiety has succeeded. After all, he didn't lose money. But I tell you emphatically, this man has failed catastrophically. He's reinforced the exact behaviors that will eventually destroy him. The professional thinks differently. He understands that across thousands of trades over a career, the only variable he controls absolutely is his adherence to process. He cannot control whether any individual trade profits. The market determines that through the interaction of countless participants, economic forces, and the composite operator's machinations. But he can control whether he followed his plan, honored his stops, sized his positions correctly, and executed his strategy with discipline. This is the professional's paradox. By focusing entirely on process and ignoring individual outcomes, he paradoxically achieves better outcomes over time. I learned this through painful experience. In my early days, I would break my rules and occasionally profit through sheer luck. The market happened to reverse just before catastrophe. I'd feel clever, vindicated in my decision to give it more room. But I was learning the wrong lesson. I was training myself to trust hope over planning, emotion over logic. Eventually, the market punished this behavior severely, as it always does. The turning point came when I began keeping a different kind of record, not just profits and losses, but process compliance. Did I follow my trading plan? Did I exit where planned? Did I size the position according to my rules? Suddenly, I could have losing days where I scored 100% on process compliance, and I considered those days victories. I'd protected my capital, reinforced proper habits, and maintained the discipline that would serve me across thousands of future trades. Conversely, I had profitable days where I violated multiple rules, and I marked those days as failures in my journal. The money was temporary. The habits I was forming would be permanent. Here's what I demand of every serious student. Judge yourself not by whether individual trades profit, but by whether you executed your process flawlessly. Did you honor your stop? Success. Did you size correctly? Success. Did you exit when your thesis was invalidated? Success. The market outcome is merely data. Your discipline is the only thing that compounds over a lifetime of speculation. Gentlemen, we've covered considerable ground today, but let me distill everything into one essential truth that has governed my entire career and separates those who build lasting wealth from those who eventually surrender their capital to the market. The 1% action that prevents 99% of losses isn't complicated. It isn't a secret chart pattern or a mysterious indicator known only to Wall Street insiders. It's something far simpler and infinitely more difficult. The unwavering discipline to cut your losses immediately and without emotion when the market proves your position wrong. I've watched this principle vindicate itself thousands of times across decades of market observation. The speculators who prosper year after year, who survive panics and bear markets, who build substantial fortunes from modest beginnings, these men all share this single characteristic. They protect their capital first, pursue profits second, and execute their stops without hesitation or negotiation. The amateur enters this business believing success comes from being right. He studies, analyzes, and convinces himself of his position's validity. When the market disagrees, he argues with it, holds stubbornly, and watches his capital evaporate. He's fighting a battle he cannot win because he's fundamentally misunderstood the game. The professional knows that success doesn't come from being right. It comes from managing the inevitable times he's wrong. He enters each position knowing precisely where he'll exit if invalidated. He sizes his position so that no single loss can cripple him. He executes his stops mechanically, treating losses as business expenses rather than personal failures. And critically, he judges himself by his process, not by individual outcomes. This approach isn't glamorous. It won't make exciting conversation at dinner parties. You won't have dramatic stories of positions you held through 50% drawdowns that eventually recovered. But I promise you this, you'll still be operating in this market 5 years from now, 10 years from now, 20 years from now, while those dramatic storytellers have long since been eliminated from the game. I've built my method, the principles of accumulation, markup, distribution, and markdown, on careful observation of how the market actually operates, not on how we wish it would operate. And the market operates with complete indifference to your analysis, your conviction, or your financial needs. It respects only one thing: your discipline to acknowledge when you're wrong and act accordingly. The choice before you is stark and unforgiving. You can protect your ego by holding losing positions, convincing yourself that you're patient rather than stubborn, that you're convicted rather than delusional. The market will eventually teach you the cost of this approach, and the tuition will be your entire account. Or you can protect your capital by honoring your stops religiously, accepting small losses as the unavoidable cost of operating in an uncertain enterprise and living to speculate another day. This path offers no guarantees of wealth, but it provides something infinitely more valuable: survival. And survival, compounded over time with disciplined execution, transforms into prosperity. I leave you with this final thought. Every professional trader you admire, every successful operator who's built lasting wealth in this business, has executed more losing trades than you can imagine. The difference is that their losses were small, controlled, and unemotional. They understood that the game isn't won by avoiding losses, it's won by managing them so skillfully that you remain in position to capture the genuine opportunities when they arrive. Master this one action, the immediate disciplined execution of your stop-loss, and you'll prevent not just 99% of your losses, but 99% of the emotional turmoil, capital destruction, and career-ending mistakes that plague undisciplined speculators. The market will always be here, offering opportunities to those prepared to accept them. Make certain you're still here to participate.